retirement is the light at the end of the tunnel. Most of us envision it as a time of rest and relaxation, whereby we enjoy the fruits of our labor. However, for many, this doesn't become a reality as they die in their 20s, 30s, or 40s. But assuming you won't die earlier on in your lifespan, the second disaster looms: being old and poor. While I can't help you with your lifespan, I can help you with the not being old and poor part. Since you will be too old to work in your 60s and 70s, your assets and future income sources will create your retirement income, so it makes sense to start accumulating them now. In relation to that, here are the best retirement income sources. 1. Annuities. Purchasing an annuity involves converting a huge sum of money into an ongoing income stream that you can't outlive. Retirees often take the money they saved up during their working years and use it to purchase an immediate annuity contract because the income stream starts immediately, is predictable, and is unaffected by falling stock prices or declining interest rates. In exchange for the cash flow and security, an annuity buyer accepts that the income payment will never increase, which means that it actually decreases in value over time due to inflation. The biggest concern for most immediate annuity buyers is that once you buy one, you cannot change your mind. Your principal is locked in forever and, upon your death, the insurance company keeps the remaining balance. Annuities are complicated products that come in a variety of forms. So, before you rush out and buy one, do your homework. 2. Pension. Although pensions are increasingly rare, they still exist, especially for government workers. If you have a pension, it's essential to learn about your benefits. If you're married, find out if the pension covers your life only, or if your spouse will receive benefits after your death. You should also have the option to choose. One choice isn't necessarily better than the other, but you and your spouse need to know what to expect if you die first. You also need to know if the pension income adjusts with inflation. Some retirement calculators lack the functionality to accurately deal with cost of living adjustments, but robust financial planning software can easily handle most pensions. 3. Home equity. If you own a home, you may be able to generate income from the equity you build over the years through monthly payments and price appreciation. However, on the downside, to access the equity, you may need to sell a home. Especially after you retire, you may lack the income required to get approved for a loan, but it might be possible to get a second mortgage or a home equity loan after retirement. Alternatively, if downsizing makes sense, you can always sell what you own and buy a less expensive property. With home equity, you could also use reverse mortgages as an option, but certainly not anything to rush into. Depending on your living situation and your wishes for the family home after death, those loans can be problematic. So, research and discuss your goals with anybody who might have an interest in the home. This gives everybody a chance to voice their opinions and identify potential problems. Cautionary to this: if anybody wants you to get a reverse mortgage to fund the purchase of a financial product, run away. 4. Laddered bonds. Bond ladders are created through the purchase of multiple bonds that mature at different intervals. This structure provides consistent returns, low risk of loss, and protection from call risk, as the staggered maturities eliminate the risk of all the bonds being called at the same time. Bonds generally make interest payments twice a year, so a 6-bond portfolio would generate a steady monthly cash flow. As the interest rate paid by the bonds is locked in at the time of purchase, the periodic interest payments are predictable and unchanging. When each bond matures, another is purchased, and the ladder is extended, as the maturity date of the new purchase occurs further in the future than the maturity date of the other bonds in the portfolio. The variety of bonds available in the marketplace provides considerable flexibility in creating a bond ladder, as issues of varying credit quality can be used to construct the portfolio. 5. Laddered certificates of deposit. Mirroring the technique for building a bond ladder is the certificate of deposit (CD) ladder. Multiple C.Ds with varying maturity dates are purchased, with each CD maturing later than its predecessor. One CD might mature in 6 months, for example, with the next maturing in 1 year, and the next maturing in 18 months. As each CD matures, you purchase a new one, and the ladder is extended since the maturity date of the new purchase is farther in the future than the maturity date of the previously purchased C.Ds. This strategy is more conservative than the laddered bond strategy, because CD are sold through banks and are insured by the Federal Deposit Insurance Corporation. CD ladders are often used for short-term income needs, but they may be used for longer-term needs if interest rates are attractive and provide the desired level of income. The interest earned on C.Ds is only paid when the C.Ds reach maturity, so to ensure that maturity dates coincide with income needs, It's important to structure the latter properly. Also, note that some C.Ds have an automatic reinvestment feature, which could prevent you from receiving the investment's income. So, make sure that any C.Ds you use to generate a retirement income stream do not include this feature. 6. Dividend. Designed to provide long-term growth and income, equity income investments can help offset the effects of inflation. As you approach retirement, keeping a portion of your investable assets invested in high-quality, dividend-producing stocks and equity mutual funds can help hedge your retirement portfolio from inflation risk. These investments also give your portfolio the opportunity to benefit from strong market performance, which is increasingly important for retirees, as many people are spending 20 or more years in retirement. However, equity investments are, of course, subject to market volatility. 7. Part-time work. Working in retirement might sound like a chore. It certainly goes against the traditional notion of retirement. But any income you earn in retirement is extremely helpful. It helps to reduce the amount you draw from your assets, and it may mean that you get to retire early. If you define retirement as stepping away from your job, then this powerful strategy might work for you. You can leave the long hours behind and earn half or a quarter of your pre-retirement salary, possibly as a consultant or under other arrangements. Also, working part-time might bring several rewards. You get to stay active and engaged when you work, which can help keep your mind and body healthy. You keep your skills sharp in case you need to re-enter the workforce for any reason. If you're doing work you love and making an impact, you get a sense of satisfaction. 8. Retirement savings. Those IRA, 401ks, 403bs, SAWs, and other retirement plans you've been using over the years can also provide income. That's what they're for. And if you're not currently saving for retirement, there's no time like the present to start. However, take note of the types of accounts you're using and determine whether or not you have pre-tax or after-tax savings. After-tax accounts like Roth accounts let you take withdrawals in retirement without owing taxes. For assets in pre-tax accounts, you need to plan for the inevitable tax hit that comes with withdrawals. You might not be able to spend all of the money in your accounts freely. Whether you pay your taxes out of those accounts or from other sources, you'll have to come up with the money somewhere. 9. Social Security. Historically, this has been a primary source of retirement income. But younger generations tend to be wary of relying on Social Security, and for a good reason. Social Security cannot continue to exist indefinitely without changes. However, it is probably not wise to ignore Social Security altogether, since excluding Social Security requires that you save more significantly for retirement, which for most translates into working more years or bigger annual retirement contributions that may be hard to achieve. On the contrary, if you're an optimist, you can always just assume all is well. But be aware that the system is in trouble and be sure you have other sources of retirement income to supplement your Social Security benefits. Also, in some cases, Social Security income is taxable if your income exceeds certain limits.